Bank of England has pushed through its fourth interest rate increase in 6 months, after warning that inflation could reach 10% towards the end of 2022. The central bank has also warned of a possible recession in 2023 to show what a difficult balancing act it has, taming inflation on one hand, but not jacking up interest rates so far the economy weakens badly or tips into recession on the other. The latest inflation figures are due in the coming week on Wednesday the 18th of May, and on the day before that we'll see the latest unemployment and wage growth numbers, which will give us some feel for how well householders are coping, or otherwise, with the galloping increases in the cost of living. The last employment data set from the Office for National Statistics, or ONS, covered the month of February, and overall the numbers looked rosy. Unemployment was 3.8%, below where we were before the pandemic. Employment was unchanged at 75.5%, only a fraction lower than before the virus broke out. And wage growth was 5.4% year on year to take the average UK weekly pay packet, including bonuses, to £598. However, the good news stopped there because inflation was running well ahead of pay growth. According to figures from the ONS, year-on-year increases in the cost of living looked as follows for the month of March. 7% according to the Consumer Price Index, or CPI, the highest figure since this measure was introduced in 1997. 6.2% according to CPIH, the Bank of England's preferred measure because it includes housing costs, and maybe because it gives consistently lower figures, and 9% for the Retail Price Index, or RPI. Now that RPI reading showed the fastest rate of increase since January 1991. Now I accept this is no longer an officially recognised statistics, but don't forget, when the RPI was last 9%, the Bank of England base rate was 13 7/8%, rather higher than the 1% level to which the Monetary Policy Committee took the headline cost of borrowing at its May meeting. On the corporate front, there's a long list of results, trading updates and annual general meetings from large, mid and small caps alike, so the coming week should be an informative one. Names which may be worthy of further study include the following, although do please note some of these dates could yet be subject to change. Snack seller Greggs on Monday the 16th of May, Vodafone, DCC, Land Securities, Britvic and Watkins Jones on the 17th, Burberry, British Land, Aviva, Future, Premier Foods and Marston's on the 18th, National Grid, Royal Mail, Kinetic, Watches of Switzerland and Great Portland Estates on the 19th, and Pershing Square, Wincanton and Young's Brewery on Friday the 20th of May. But the company which could just cause the biggest fuss in the week ahead might be Imperial Brands. The tobacco giant, whose key brands include JPS, Davidoff and Gauloises, is due to report its first half earnings to the end of March on Tuesday the 17th of May. The shares are broadly unchanged over the past year, perhaps as investors continue to mull the long-term future for smoking in the wake of a respiratory viral pandemic, the ongoing regulatory pushback against the industry, and Imperial's own efforts to adapt to the possibility of a brave new world by developing its next generation products. The market may also still be considering whether Chief Executive Stefan Bomhard's 5-year plan, launched in January 2021 after a string of profit warnings, managerial upheaval and a dividend cut, is attainable or not. Remember that this 5-year plan's key goals are a focus on 5 key markets in tobacco, namely the US, Germany, UK, Australia and Spain, and they generate more than 70% of the group's combustible products profits. A reset in next generation products to stem initial losses and build for long-term growth. Simplify group operations to save between £100 and £150 million in costs a year, to fund increased investment in core cigarette brands to the tune of 50 to 60 million a year and drive next generation products. Drive net sales higher by 1 to 2% a year up to 2025, and hold operating margins in the near term and then generate mid-single digit operating profit increases on an organic basis between 2023 and 2025. Now, the first half results will be viewed in this long-term context, but also from the perspective of the guidance given for the year to September 2022 by Mr. Bomhard alongside the full year results and then updated alongside March's trading statement. That update reflected Imperial Brands' withdrawal from Russia and the impact of the war upon its Ukrainian business. The two countries had previously generated around 2% of group sales and half of 1% of adjusted operating profit. As a result, Imperial now expects revenue growth of between 0 and 1% on a constant currency basis, and sales will be the first figure to which investors will therefore head when they look at the first half results. In the first half of fiscal 2021, Imperial generated sales of £3.6 billion on an organic adjusted basis. Here, analysts will also look to the mix between price and volume. In fiscal 2021, totally, stick volumes were down by 2.9%, prices were up by 4.4%. The second number to watch is operating profit. Again, on an adjusted basis, Imperial has guided to broadly flat operating profit for the year as a whole at around £3.6 billion. And the base for comparison from the first half of a year ago is £1.6 billion. Note that the withdrawal from Russia will see Imperial take a £225 million accounting value hit, although that will be excluded from the underlying profit calculation. On a stated basis, Imperial Brands made £3.1 billion last year and £1.6 billion in the first half. The third figure to watch is net debt. This has come rattling down, helped by strong cash flow and the sale of the premium cigars business last year. And that figure is important because the stronger the cash flow and the stronger the balance sheet, the greater scope Imperial Brands has for making cash returns to shareholders, and dividends is the fourth and final number to watch. Analysts are looking for a 3% increase in the full year payment to 143p a share, so that rate of growth is your benchmark for the first half. A year ago, Imperial declared a distribution of 42.12 pence a share. Note the firm does not currently run a share buyback programme. I hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you again next week.